Good afternoon. We're going to go ahead and get started. It's 12:01 according to Verizon. So we're going to start the webinar. This is your monthly Learn and Earn webinar brought to you by your Cincinnati Area Board of Realtors Realtor Lender Committee. I'm Dan Hickman with American Mortgage Service Company. Greg Amburgy with RVS, Residential Valuation Services, is here as well. And Gayla Geis with Prodigy Title. And we're going to talk about, from a lender's perspective, an appraiser's perspective, and a title agency perspective, why your closing isn't happening on time, and how to expedite the process. And our favorite part, I think, is at the end of our little presentation when you get to ask questions, and we will do our best to give you excellent answers. It is the presentation itself will take maybe 10-15 minutes, and then we'll open it up to the questions. Please feel free at any time during the presentation, as questions occur to you, to type them in to the right-hand side of your screen using the question tool from this GoToWebinar tool that we use here. So on your screen now, you should see the first screen, which is why isn't your sale closing? How to expedite the process. First, preparing the buyers for the application process and encouraging real pre-approvals. And by real pre-approvals, we mean not just pre-qualifications, which most of us that have been in the business for a while can do very easily, but actual pre-approvals where the underwriter for the lender or an underwriter for the lender actually reviews the information and gives a true pre-approval, and the lender issues you a pre-approval letter so that you know that borrower is good to go before you even start looking at properties and considering making an offer. A quick review of the borrower's checklist under income. Remind your borrowers that they need to pull together their pay stubs for the most recent 30 days, their W-2s and 1099s for the past 2 years, their federal tax returns for the past 2 years. Under assets, their bank statements for the past 2 months, their most recent retirement account statements, 401ks, IRAs, TSAs, their listing agreement or contract on their current home, if that's applicable. Have them get that information together to provide to their lender. Explanations, this is a big one these days. You could prepare your borrowers to need to explain all inquiries on their credit report that their lender pulls, all inquiries within the 120-day period prior to that credit report date. The lender needs an explanation from the borrower to identify why that inquiry occurred and whether or not any new debt was obtained. The lender has to be sure that they are using current liabilities when calculating the borrower's debt-to-income ratio and making sure that the lender documents the borrower's ability to repay. Also, the borrower would have to explain any inconsistencies on pay stubs or payroll deductions on pay stubs that aren't clear in and of themselves how they appear on the stub. They'll have to explain any gaps in employment within the past 2 years. Typically a gap of 30 days or more, the lender will require an explanation. These are all standard lending guidelines and should not vary much, if at all, from lender to lender. Also, all deposits on bank statements that the borrower will provide these days. Lenders are required to document the source of all funds for the transaction. Lenders are also required to review bank statements for any deposits that appear to be inconsistent with a borrower's income and question those deposits and obtain documentation for the deposits. And these are all federal regulations now. Lenders are even required to file a suspicious activity report or a SAR if there are deposits or transactions that are inconsistent with a consumer's cash flow. And that's part of the Patriot Act, as lenders are now part of the policing of terrorist activity or money laundering. So that's, in other words, it's not simply for the loan in question. And lenders are not doing it just because we like to. We're doing it because we have to. Also under the borrower's list, additional documentation. As applicable, borrowers will need to provide copies of court orders and or divorce decrees and or separation agreements when you're dealing with child support or alimony, or obligations that are no longer theirs due to a divorce, for example, a previous house or a previous car note. If there's been a bankruptcy, they're likely going to need to provide a complete copy of their bankruptcy papers and explanations and possibly third-party documentation to explain why that bankruptcy occurred, and equally, if not more importantly, why it's likely now that they are beyond their financial hardship. Copies of leases if they have rental properties, and so on. So as these different things apply, if borrowers are prepared to bring that information in up front to their lender, that can help expedite the process. When it comes to the purchase agreement or the contract, please be sure to provide a clear, complete copy of the contract with all of the addenda, contract addendums to the lender. Obviously, the title agency is going to need that as well, and the appraiser. So we're all three on the same page here, going to need that. And it's also very helpful if everyone's names on the contract are fully legible, the buyer and seller and the listing agent and the selling agent, particularly if the borrower is getting government-type financing and the lender needs to do a check of all the parties involved in the transaction to make sure they're not on HUD's exclusionary list, for example. When we get into the appraisal, important information for your appraisers would include the existence of multiple offers on this deal that may have pushed up the price, existence of multiple parcels on the property in question, the dates of any updates or remodeling to the property, and possibly the dollar amounts that were put into it?
Not necessarily the dollar amounts, but definitely the dates. That is required on the appraisal.
Okay. Also, any major structural or system repairs that have been made to the property. Also important for the appraiser to know if the transaction is not an arm's length transaction. So if there's anyone involved in the transaction, buyer and seller that are related, or an employee-employer type relationship, that's needed to know as well. If there is a short sale or a relocation, if there is urgency on the part of the seller, that's been part of the motivation for the agreed upon price. If the seller is an executor of an estate, these are helpful pieces of information for the appraiser to know. Under the appraiser independence requirements, and we're going to read this verbatim, no entity with a direct financial interest in the transaction shall influence or attempt to influence the development, reporting, result, or review of an appraisal through coercion, extortion, collusion, compensation, inducement, intimidation, bribery, or in any other manner. So that's what it says under appraisal independence requirements. It doesn't say you can't communicate with an appraiser.
Exactly, and that's why we try to have everybody keep your communication fact-based. For instance, in this, you can say, hey, I just wanted to point out that this is the biggest lot in the subdivision. It's on the cul-de-sac. It's the best lot. It's 3/4 of an acre. But you can't tell the appraiser how to interpret the facts. But you can give us all the facts you want to, and that doesn't violate any rules.
When the appraisal comes in low, here's a quote from Stephen Covey: "Seek first to understand, then to be understood." We can all appreciate that and apply it to ourselves. Read the whole appraisal first, especially the comments. The lender should be providing the borrower with a copy of the appraisal very expeditiously once it's been received and reviewed by the lender, and at least 3 business days prior to the closing. One of the new requirements, effective January, just a month and a half, almost 2 months ago now, is that the lender is required to provide the borrower with a copy of every estimate of value. So not only the appraisal, but also if any AVM, automated valuation, has been pulled on the property, if there's been a field review, a second appraisal, the lender is required to provide all that information to the borrower at least 3 business days prior to the closing so that the borrower can review it. Whether or not they do, I guess, is debatable, but this is the rule now. There is an option for the borrower to waive this right as long as they waive it at least 3 business days prior to the closing. The policy of whether or not the lender in question will allow a borrower to waive this probably varies from lender to lender. It could be that only in circumstance where the lender feels that it is appropriate, they will then allow the borrower to waive this. Some lenders may be allowing them to waive it from the very beginning, which some would feel is inappropriate, kind of contrary to the intent of the rule. But in any event, once the borrower has a copy of the appraisal, they can provide it to whomever they want. But typically a lender will not provide the appraisal directly to anyone other than their client, being the borrower. Also, when the appraisal comes in low, is it possible that the appraiser is right? Maybe he does know what he's talking about. Also keep different perspectives in mind.
Let me explain this one. Realtors are looking for what they think is going to happen in the future, in the near future. When they're figuring out where to list a price, they're trying to where to list a house, at what price. They're trying to figure out what's this house going to sell for in 2 months. Appraisers, we always look backward at what has already happened, at factual information. So sometimes the market's in flux. For instance, when they built the new casino downtown, I did an appraisal where I was looking back at the last 6 months, and all of a sudden we had a whole new group of people that wanted to live in condos downtown, and the prices of condos were skyrocketing, and I wasn't seeing it. And so a realtor pointed out to me in a very tactful way that there were a bunch of pending sales that I wasn't considering, and when we gave the appraisal a new effective date, based on the sales that were starting to close that week, and the value went up to where the sale price was. So I was looking backward, and realtors are looking forward to see what's going to happen or what's happening now, and that's just sort of the way our jobs are designed. Yeah, and then we are also trying to figure out, does this sale meet the requirements of a market value sale? And the market value basically says, what is the most probable price that an informed buyer and an informed seller acting in their own best interest would come up with? And so sometimes you may have a sale price that has influences, like a seller just desperately needs to sell a house because they've been transferred and they're just going to take anything that they get. And so the appraisal may actually come in much higher than the sale price in that particular information. But we need all that information. The more the realtors can supply that to us, the better. And then also, if you get a low appraisal, have an unbiased third party look at it. Because you're emotionally attached to it, the appraiser's emotionally attached to it because it's his work or her work. Have another appraiser or another realtor, maybe have your broker look at it and say, did we just price this wrong? And they might give you some ideas on how to go about coming up with a rebuttal. If you're doing a rebuttal, don't make it personal. I've had people that threatened to take me to the state because my appraisal came in low or whatever, and that's not a good way to start off trying to come to a better result. But just again, keep your facts, keep your information factual and not personal. Again, emphasizing the most recent comparable sales. And then another thing you might consider is sales from 6 to 18 months ago that the appraiser may not be looking at because he's trying to find what happened in the last 6 months because that's what the lender's requiring. But there may be some very good comparable sales from 2 doors down that happened 12 months ago that are very relevant to this sale price, but the appraiser missed them because he was just looking at the last 6 months. So take a look at the newest stuff and also older things that the appraiser might have missed. And then provide any information that's not on your MLS sheet. We're generally going to read your whole MLS sheet to find out information on the property. If there's anything on there that's important to us that's not on the sheet, get that information to us. And it's almost important about 100% of the time now that if you've got a vacant house, the utilities have to be turned on. FHA always requires that, but now almost every other lender is requiring it, at least the ones that I work with. And then information on updates of the kitchens and bathrooms especially.
Before we jump into the title company, just a quick question for you, Greg. Would it be advantageous, would you agree it would be advantageous if when you schedule the inspection of the property or the visit to the property, I probably shouldn't use the word inspection, but when you schedule to visit the property to perform the appraisal, if the listing agent or someone on their team provided you with a list of their comps that they used when they listed the property and a list of the improvements or repairs that the seller has made, if they provide that information to you up front, is that helpful?
I generally don't like people providing me with comps. I don't mind, but some appraisers take offense at it because it's the most important part of our job and we feel like you're trying to do our job for us. But especially if you have an oddball house, if it's not in a subdivision somewhere where you've got 5 comparable sales from the last 6 months, and you found a comparable 3 miles away, if say it's out in the country, by all means supply that to us. What I would do if I had any information that was pertinent to the appraisal is I would put a note for my office to force the appraiser to schedule the appraisal directly with the listing agent, if you're the listing agent, so that we actually have to call you on the phone and you can get us on the phone and say, hey, by the way, there's a second parcel behind this thing that's included in, it's not a half-acre lot, it's a 1 acre lot because there's a second parcel behind there that you might miss or something, any information like that that you want us to get. If it's a slam dunk and you know there's going to be no appraisal problems, that's fine. Let centralized showing schedule it. But if there's any information you need us to see, put a note in there to have the appraiser call the listing agent.
And from a lender's perspective, I'll say that when an appraisal does come in and it's low, the lender should not have any problem at all being willing to go back to the appraiser and provide information from the agent or from the owner, if it's a refinance, for example. And that information might include properties that they think might be considered as comparables at that point. Maybe there's one that the appraiser missed, or maybe the comps aren't better than what was already used, but it's worth a shot. And also information regarding the improvements and whatnot. And
I'll say this every now and then, not to disparage the good people at Rapatoni, but say if I'm using the radius search, I'll radius search something and then go back the very next day and radius search the same parameters and get a house that wasn't in there the day before for some reason. I don't know why that occasionally happens, but sometimes we miss great comps. It happens.
All right. We look forward to getting into the questions here. We're going to go through the tips from the title agency piece now to expedite the closing. First, communicate with the title agency. Complete and return the realtor information sheet to the title company in a timely manner. Most of the title agencies that you're working with probably send you, as soon as they have the title request, an information sheet to complete and return back to them. And also include tax IDs and or acreage for the property. You can prepare your sellers and buyers. We'll get to that in a moment. Preparing sellers, they're going to have to bring their photo ID to the closing. They're going to have to bring their spouse to the closing if they're married. If they're going to need a cashier's check or wired funds, if they're going to need to bring funds to the closing. And usually when there are wire transfers involved, the bank wants the person actually at the closing, the seller at the closing. Likewise, if the buyer is going to have a wire sent. If there's a power of attorney involved, the title agency should be reviewing that, needs to review that before the closing. And they're going to need the original power of attorney. And keep in mind, too, that POAs are often not permitted for trusts or short sales or HUD sales. So anytime you know that there's potentially going to be a POA needed, communicate with the title company early in the process. Also, if applicable, prepare the sellers that if it's registered land, which is pretty common in Hamilton County, they're going to need the original registered land certificate. If applicable, they'll need original death certificate for survivorship affidavit or TOD, transfer on death. Thank you. Thank you, Gayla. Also, a copy of the trust, if there's a trust involved, from the trustee before closing. If there's an LLC that's selling the property, they'll need a copy of that operating agreement. The LLC does still need to be currently active. If applicable, from the seller side, a corporate resolution showing the authority of the company to sell the property, and also the authorization for the specific person who's going to sign. If applicable, a paid in full affidavit and CO if new construction, a certificate of occupancy if new construction. Preparing the borrowers, very similar. The buyers, make sure that they know that they need to bring their photo ID to the closing, even if they've already provided their ID to their lender during the application process. If they're married, they need to bring their spouse, even if he or she is not on the loan or even on title. And cashier's check or wired funds, the same as we talked about for the seller. And original POA and reviewed by the title agency before the closing. Again, as we discussed for the seller, the POA, when applicable, must be acceptable. It must give them the appropriate power to sign for a real estate transaction. It has to be reviewed by the lender when it's being used by a buyer. The POA needs to be reviewed by the lender in advance of final approval and moving it to closing, and also by the title agency in advance of that closing. A lot of times the title agency is the attorney there. Nick, for example, would be preparing the POA.
And the reason we need original documents is because the county requires that it be an original document. If you have a buyer and they're not paying cash, then they're signing for their spouse, we would need that original power of attorney to record with the mortgage. If it's the seller and they're signing on behalf of their spouse, we have to have the original power of attorney to record the deed. Now, they will get those original power of attorneys back once they've been recorded.
Awesome. Okay, that was Gayla Geis with Prodigy Title. Okay, and she'll be back to answer some of your questions. Remember, too, with the buyers, if they're getting a bridge loan, not as common these days as maybe a decade ago, but anyway, if they're getting a bridge loan or a home equity loan for part of their funds for their purchase, remember that rescission period when they go to closing on that, since it's secured by their current primary residence. So they're going to have to wait 3 business days and have those funds available on the 4th business day after they sign that note for that bridge loan. Provide the lender and the title agency trustee information in advance for approval if there is a trust involved on the buyer's side. Let the title agency know up front, and this is probably also on the questionnaire that they send you, the form that's sent to you up front, how title is going to be held, and also let them know if there's an LLC, if the buyer is actually an LLC, and if that's permitted by the lender. When it's time to prepare for the closing, and in about 1.5 years, we're all going to have HUD-1s 3 days before closing, and we'll be dealing with that then. But when you are reviewing that HUD-1, hopefully at least a day or so before closing these days, check the HUD-1 for accuracy, the property address, the borrower's names, the seller paid costs, the property taxes, the prorations, any bills to be paid for inspections or repairs, any HOA fees, the home warranty, etc., those types of things. Make sure that they're not missed. A second set of eyes looking at that for the title agency and the lender. Obviously, too, the commissions and the adjustments for the earnest money that may have already been paid. And ask your preferred lenders and title agencies, and when you're talking with the appraiser that's performing an appraisal on one of your transactions, ask them too for suggestions on how you might help expedite the whole process. We're all in this together. We all want smooth, timely closings, and that's how we all grow. And
I've never had a file that had too much information.
Excellent point. Now, I may have as a lender. Too much information for an underwriter can be tough, but Gayla just added that, she's not had a file with too much information, and that probably goes for the appraiser too. So as a lender, well, we have to be a little careful. Once the underwriter sees something, they can't forget they saw it. Let's get into the question and answer period. If I can get that, there we go. All right. Is there ever a problem with a short sale and registered land?
A short sale is where is where the seller of the property is actually signing as the seller. Now, if it's a bank sale and it's registered land, we have run across problems where the registered land cert hasn't been re-recorded through registered land. Now, there is a thing that's called an affidavit for a lost, destroyed, registered land certificate, which is a $30 fee through Hamilton County. If in doubt, we always will get one of those instead of an original. You don't always have to have the original. Okay, an original power of attorney, an original deed, an original trust document, those are way more important than an original registered land certificate because you can get a lost or duplicated one.
Okay. Here's a question for the appraiser. Can we share with the appraiser how the buyer interpreted big lot, first floor, master, etc.? After all, it is the buyer who found the value in items like this.
Excellent question. And again, we go back to what the appraiser's task is according to all of our requirements. We are supposed to find what is the most probable price that a typical buyer would say. For instance, your buyer may live next door to it may be next door to his parents or his best friend, and he finds extra value in this property because he can walk over to his parents' house, maybe they're aging, he can take care of them. The typical buyer doesn't care who lives next door, or they don't, so we may be, if that thing has a big lot, we're trying to find out as appraisers, what is the market's reaction? What is the typical buyer, the typical, buyer out there? What are they going to say about the lot? But that's a great question.
So unfortunately, it's the market value that's
right, because the lender wants to know if they have to resell this property, your buyer's not going to be the one they're reselling it to.
All right. Next question. When is it appropriate for a loan officer to say, remove that item from the contract, put it on an addendum, do not send me a copy of the addendum? The answer to that question would be never.
Never.
That is,
exactly.
that is never appropriate. That would be fraud. Here's what the loan officer needs to say to them. That the loan officer needs to say that item needs to be removed from the contract. They can purchase it under a separate contract for a separate dollar amount, and they're paying cash for it. It's a separate transaction. They can't say, remove it from the contract, put it on an addendum that you don't give me. That would be fraud. That would be inappropriate. The problem is, and like a lot of different things, over the last decade or two, it wasn't as often a problem. But now that the entire industry is under a microscope, all of the rules, most of which have been here all along, are really being adhered to closely by investors, by lenders. Fraud never should have been acceptable, obviously. But here's one, for example. We used to be able as lenders to say, right in the contract that the pool table is given no value. And investors accepted that, and it wasn't a big deal. That's not acceptable anymore, unfortunately. And we as lenders have to deal with that. So if there is an item of personal property in a contract, the lender has to give it value, the appraiser has to address it in the appraisal, and we have to deduct it from the value, the purchase price. Now, there may be times when it's perfectly acceptable and it doesn't make a difference. We're simply recalculating the loan to value based on the adjusted price after deducting for the property item, the personal item. And if the loan to value still works for the borrower, then nobody even knows it was a problem. It wasn't a problem. Too often, though, we have borrowers at the minimum down payment or right at a 3.5 or a 5 or a 10% down payment, that making this adjustment throws them into the higher LTV category and does cause some challenges. So the answer to your question is never. A loan officer should never suggest that. In the real world, working out there, those items of personal property should not be in the real estate contract. Okie doke.
You see that a lot with your John Deere lawnmower out in the country. If somebody's got a nice tractor and they
Play sets.
Play
Yeah.
sets, pool tables,
big
screens.
Yeah.
Okay. Great question. Very real world. All right, I'm trying to see if we have additional questions here. Okay, we got that one. We got that one. When is it appropriate for a realtor to give a buyer a rebate? That would be a lender question. That would be in the interested parties' contributions. I'm assuming what you mean here is give them a credit from your commission at the closing table to help them pay closing costs. It's not a violation, but it does need to be included in the 3% or 6% limit that, depending on the down payment and the product that your borrower is getting. In other words, FHA financing allows the borrower to get up to 6%, and that can be from the seller. It can also be from the agent involved in the transaction. The lender can always pay costs for the borrower. That's typically built into pricing when that happens. As an appraiser, are you concerned with that?
I've not actually seen that. Our rule is always, if there's anything going on, disclose it, and you're likely to stay out of trouble. So I'm assuming, and that might be a question for a lawyer, but my gut reaction would be if you disclose it, it wouldn't be a problem.
And from the title agency point of view, it needs to be there, obviously, so that you can put it on the HUD-1. From a lender's perspective, again, if as we're getting close to closing and we learn that the buyer is a couple of $100 short or a few $100 short to get closed, and the seller's already participating and they're not going to participate anymore, the realtor could participate. The lender could participate. It's not unusual at all for a lender to say, yeah, we'll do a credit of X amount, and the agent might participate for Y amount, and so on. It's not something a loan officer or a mortgage loan originator, to use the official term, can do on their own anymore. Thanks to Dodd-Frank, loan originators cannot alter their individual compensation on a deal-to-deal basis. So in the old days, a loan originator could say, hey, I'll cut X amount of dollars out of my commission and pay this on behalf of the borrower. Can't do that anymore because of Dodd-Frank. A lender could still agree to do a lender credit for a borrower. And in the real-world application of that, what that typically would mean is the loan originator speaking with his or her manager and getting the approval to do that if necessary. When it's known up front, it's a lot easier, and it's essentially built into the pricing, and that's why one lender might have lower costs than another. It's in there somewhere. Next question, how would we handle a $100 credit to make a repair on the home inspection? Can it be a line item on the HUD? Example, patio missing a screen door, seller credits $100 so they can buy one themselves after closing. From a lender perspective, the lender is probably going to require that it's done before the closing, not after. Escrowing for any types of repairs is very difficult to do these days because of investor and secondary market requirements. Now, rehab loans are very popular, whether it's Fannie Mae rehab, the home style program, or FHA 203K rehab programs for minor items all the way up to very significant items. But providing a credit at the time of closing to make a repair after the closing is probably going to be difficult for the lender to approve, because you don't know that it's going to be done. It would be best if it would be done before closing. Okay, next question, I think. Good questions. All right, we're looking for another question. Again, this is part of your Learn and Earn webinar series put on by your Board of Realtors Realtor Lender Committee. Next month's session is going to be specific to the appraisals and appraisal red flags. That should be a very timely, very popular topic. So
because realtors just love appraisers, it's. So next month we're going to deal with a lot of the issues. We're going to delve into the appraisal issue pretty deeply.
All right. And Greg will be back for that. Let me see here. Next. Another option, of course, great point. Somebody typed into a credit here. If somebody was going to do a $100 credit to make a repair on something because you did that to help the deal come together, you told the buyer, okay, hey, we'll credit you this. The easiest, best way is to just do it as a credit towards closing costs or prepaids. That's done at closing. There's none of this, I'm going to give you money now for a repair you're going to make in the future. If we're giving them money now for repair or new carpet or anything else that they're going to do in the future, that's an inducement, and that affects the loan to value again.
And it's also going to change the appraisal because the house with the bad carpet is worth less than the house with the new carpet, so the value would change in the appraisal.
Awesome. Okay. We hope that this information has been informative. We hope that you will share the information with your offices, with your peers about this monthly Learn and Earn webinar that the Realtor Lender Committee puts on. And we hope that you participate next month in the Appraisal Red Flags webinar, because everyone loves appraisers. We're all in this together. And with that, thanks again for participating. We'll wait just a little bit longer in case there's another question that we've missed that hasn't been keyed in yet. Feel free to reach out to anyone on the committee as well. Yep, I think we covered all those. All right, thanks again.